Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Zach's Director of Research, Shiraz Mian, who is our earnings guru, to talk about, of course, earnings. And a lot's going on with earnings right now. We're about to enter into the first quarter earnings season. And believe it or not, earnings do actually matter. Sorry to tell you, all those GameStop investors, but they do normally matter. And a lot is going on with them. So Shiraz, it looks like it's a real bullish situation right here with the earnings. I don't remember the last time they were up like the double digits year over year, except for the tax cut time period.
That's right.
That's when we saw those huge gains year over year, and everybody's like, oh, it's just because the tax cuts. It's not quote unquote real, but this is similar sizes, but we are coming off of, the bad earnings from last year, at least at the start of last year, right when COVID hit. So where do we kind of stand?
So just a brief comment. You mentioned the GameStop fans, and to them, GameStop is scheduled to report earnings today after the close.
I know.
So I'm not sure how much GameStop earnings matter to GameStop stock, but to the rest of the market and the rest of the stock market, they do matter. So yes, double-digit growth in Q1, even crazier growth in the June quarter, and all of that continues in the second half too. But just to put things in context a little bit, Tracy, we have to remember that these are year-over-year comparisons, and even though Q1 20 wasn't completely washed in COVID as Q2 was,
right.
The month of March was, and finance is such a big contributor to overall earnings, and all the big banks had taken the loan loss reserves, booked huge amounts of those. So there's that's right. So there's this comparisons issue, which is helpful, but beyond that basic arithmetic, there is some genuine improvement in the earnings outlook. We see that in technology, we see that in energy, we see that in a variety of the cyclical sectors where there's clear momentum in underlying business trends, and that is showing up in estimates.
Yeah, one of the areas I was looking at for first quarter that you talked about in your earnings outlook pieces was in technology. And I was surprised to see that it's expected to be up this first quarter 21.8%.
Yes.
And I didn't think, even if, it had a partial COVID hit or whatever, but tech really didn't have as badly as a hit. And then to see that one still up 21.8 is pretty impressive.
It is. In fact, technology of the big sectors was the least negatively affected by COVID.
Okay. That's what I was. Yeah.
Yes. So there were patches. As we all know, technology is a very broad area, and there are some parts that are more kind of economically sensitive, and then others that have a lot positive going on. So all these digital sales and AI and semiconductors and all of that has been booming for some time, and that actually got a boost from COVID. And then parts of the technology space that depends on conventional spending on hardware and other material like that has been weakened by COVID. But that's been such a such a shrinking space of the broader technology pie. The growth has been on the cloud side, on the digital side, and that part of the business has been booming.
Yeah. Now you also say that 10 of 16 sectors are up in the last 3 months, and it's led by autos and energy, which have both doubled in that time. But then energy is still expected to be down 7.9% year over year. But is that because of how horrible it was a year ago? And energy has just been struggling for quite some time anyways. So even down 7.9 is still a huge improvement, it sounds like.
That's right. Yes. So yes, energy was one of the badly hit areas. Not as badly hit as transportation is or as discretionary was, but still demand practically evaporated in Q2 last year, particularly towards the end of Q1. But the more impressive development on the energy front has been the momentum in commodity prices. And not only has oil prices recouped a big chunk of what they lost, but demand outlook is improving. The demand for refined product is improving, and a whole bunch of the industries where crude products get used as feedstocks in the chemicals and all the other economically sensitive areas, the outlook for those areas has been steadily improving too. So a big reason for the optimism on the energy side is how strong the positive revisions trend has been.
Okay.
And that's a comment on the auto sector as well. Many of us did not see how strong the demand on the auto side has turned out to be. I guess we shouldn't be surprised, but it wasn't in the estimates, and that has started showing up both for Q1 as well as for the coming quarters.
Does the auto sector for us here at Zacks, is that the manufacturers and the parts guys? Does it also include like the retail side, or is the auto retailers in retail?
The auto retail is in retail. We have all the different original equipment manufacturers, so the major major automobile makers, truck makers, and then everyone that supplies to them.
Okay.
That's in the auto area. So that'll include, in addition to parts, we'll have the tire makers and everyone involved in the supply chain.
Okay. Finance is expected to be at 45.9%, but now that you've mentioned about the reserves that they had to put into place a year ago, maybe that's not as good as it seems, or is it?
It is actually. So there is the simple explanation of the base effect. So the year earlier period was pulled down by those unusual reserve bookings. So the comparison to this first quarter, which is a more normal period, looks better. But all this chatter in the market, the fascination with the steepening yield curve, the longer end of the Treasury yield curve going up, that is a directly beneficial development to the financials in general and the banks in particular. It's a direct boost to their margins. So estimates for the financials have been going up because the margin outlook for financials has been improving as the 10-year yield has been going up.
Yeah, I don't think I've ever seen this many banks as Zach's number one ranks, like the kind of smaller community and regional banks that we have ranks on. There's like dozens of them as number one.
That's right. That's right. Yeah, yeah. The outlook, even though the top line, the revenue outlook, is very closely tied to the economy, and the outlook for the economy is improving quite a bit too. But the big positive for banks is on the margin side. As these interest rates go up, every new loan that they are making is bringing in more money for them than it was a year ago.
Yeah. So where is the weakness in the first quarter? Is there any?
Yes. So transportation still remains problematic. Right. And air transportation is a big part of our transportation sector. As you know, we do have a standalone transportation sector, which helps us look at this granular level trend and development, unlike the conventional placement of transportation in the industrial services area. So transportation is still hurting a lot. The outlook for the railroads and the trucking is good, and it's tied to the trends in the broader economy. But the air travel is still a big constrained part of it, and that remains very weak. And then discretionary.
Okay.
Discretionary has a big component in these hotels, casinos, and all that kind of businesses. And that's, again, very closely tied to travel and leisure and hospitality. And though the outlook for those businesses has improved, and we see that in the stock prices, the actual nuts and bolts of their profitability is still pretty bad.
Yeah, I've been warning people about like the hotel stocks in particular. They've had huge runs off those March lows of a year ago. And, as soon as the vaccine was announced in November, they took off again. And everybody thought, oh, the worst is over. But like the valuations are super stretched and kind of insane because they're still losing money every month. They're still burning cash with no real indication of when they might go cash flow positive still.
Sure.
And the stocks have just, a lot of them have retaken their pre-COVID highs, but the earnings aren't anywhere near what
That's right.
So I feel like that's a little danger zone for those. If you aren't already in that trade, if you already didn't get in like 6 months ago, I feel it's too late. People should be waiting on those.
That's right.
Okay.
And one brief comment on that, Tracy. We tend to kind of lump everybody in the same trade. So reopening good for leisure hospitality, everybody gets lumped into that on the downside as well as on the upside. So an air carrier that's more domestic and would benefit as we reopen more is perhaps makes a lot more sense than someone that's more international oriented, more geared towards business travel, because that will be a lot slower in coming back to normal. So not all of these players benefit to the same extent from the reopening trade as the market action seems to suggest.
So it sounds like you're basically indicating that an investor would be better off buying like a Southwest or a Spirit Airlines or Alaska maybe.
Right.
Versus a United or a Delta that has a lot of international routes.
Exactly. So, so the international travel, as we are hearing all these headlines about how the vaccination rollout in Europe and in other parts of the world is a lot slower than it is in the U.S., and that will have knock-on effects on how how quickly they can reopen. And but even beyond reopening, there is this emerging thinking that perhaps business travel will take a lot longer than was the case. We, even though of all the negatives we all have internally developed against Zoom calls and everything, it is a far more efficient way and simpler way of doing business than traveling across the world for a single meeting.
Yeah, for sure. Yeah. So what do you think about the plays like Zoom, the pandemic plays that were huge last year in 2020, and now they've taken a bit of a hit now that the vaccine is rolling out and people are thinking about the recovery, but it sounds like maybe the good times might not be over in some of those pandemic plays.
Yes. So we need to see the other side of the pandemic, and we need to see some measure of normalcy return, and then we evaluate how much we value these services. I strongly feel that a lot of these services that we relied on heavily during the lockdowns will be with us on the other side, and it isn't just a one-time phenomenon, but the magnitude of that demand needs to be test-driven and stress-tested. And I don't think none of us is in any position to know definitively to what extent we'll be relying on that. But I strongly feel we will be relying on it.
Yeah, Zoom video, which is ticker ZM. Always remember, it's not the other one. I won't say what that one is.
That's right.
It's ZM. They had a 52-week high of $588, and they're down to $342 right now. So that's a pretty big pullback there.
Yes.
So we'll see what's going forward. I mean, a lot of the traders have just taken their gains and gotten out of there, but like a lot of those kinds of plays are going to be interesting. What about on the retail side of the pandemic and what those estimates are looking at? Like, I took a look at Amazon because obviously that was a big pandemic play, and their earnings growth looks like phenomenal going forward. Even this year up another 18%, and then next year expected to be 37% for just earnings growth. But then I took a look at Target, and that's expected to decline 8.8% this coming fiscal year. So what should I be thinking about some of these like retail pandemic plays now?
So there is a distinction in the broader retail space. I think the smarter thing to do would be that companies that were deemed non-essential and were down because no business, and that forced them to go digital and make those changes that in normal circumstances would have taken them years, ended up being executed in a matter of months. Now would be the time for those companies to benefit from those investments.
Like, who would be an example of that? Like, are you talking about like a Dick's Sporting Good that had some digital, but then their stores all shut down, and then we all had to order online from Dick's, and now their digital is much better and more efficient, or even like a Macy's that had to do the same thing?
Exactly. So yes to both of them.
Okay.
And I think the more interesting opportunities could be in the likes of Macy's, because one could envision them being such a bellwether for traditional department store shopping experience, even though the digital experience and the what we encountered during the lockdowns was comfortable and efficient. there may be a huge pent-up demand for just going in the stores and sampling and going back to how life used to be type of stuff. And to the extent that these companies have relatively stable financial profiles, and they were able to make investments in the digital side of their business and have a good enough physical footprint complementing that, these companies could be strong beneficiaries of that. A Target, a Walmart, a Costco, who were deemed as essential and got a huge boost in their business as a result of that, obviously will have some fall off in that business.
Yeah.
So the outlook for them is still very strong. They ended up making huge investments in the digital experience too, and a number of them have really come out with compelling digital offerings that could stand their own vis-a-vis an Amazon or another digital-only kind of player. But they will have relatively more competition on the other side compared to what they had last year.
Okay. Yeah, that's interesting because, I don't know about you, but I'm not super excited to go to like a supermarket or any of those kinds of things right now, or like a Walmart or a Target. But I would be excited to go to like the shopping mall and into some of those stores like the Gap or a Macy's again, and just kind of like wander the aisles.
Sure. Yeah. That's the type of experiences that we missed during the lockdowns.
Yeah.
And that's an easy urge to satisfy once we don't have as much fear about the pandemic as we had in the past.
Yeah. So what do you think about the shopping mall stocks, if we're going to talk about, doing the experience? Those have had big recoveries already, but could they see further? I'm taking a look at Masaryk. They own a lot of the big kind of lifestyle malls that people know that like Macy's are in, and they're expected to have no earnings growth this year, but coming off of last year, I guess that's not a bad deal for some of them. But I've been watching these for a while, and these kind of remind me of the same scenario as what's happening with the hotel stocks, but Masaryk still only has a PE of 6 right now.
Yeah.
So
yeah, I would think there should be opportunities. I don't know specifically about that, but I would think there should be opportunities in the REIT space. The issues that came to the front during COVID are related to the brick and mortar and the traditional retail space had been in play for years ahead of the pandemic. So none of those issues were new. There were a whole bunch of traditional retailers that were going out of business and were experiencing steadily declining traffic and footfall. So all of those are or had been priced in and reflected in their market values already, to the extent that some of these players have the financial capability to stick around and withstand some period of limited profitability. I can't imagine traditional retail all disappearing. There will be retail, as you mentioned, the need and the desire for to go into a store and browse and spend some time there. And then obviously the secular trends that had been in place pre-COVID and were accelerated during the lockdowns will remain with us post-COVID as well. A lot of the things that we have become used to shopping online will probably we will stick with that. And that's probably a benefit to an Amazon or a Walmart or any other player that we relied on over the past year.
Yeah. Let's wrap it up with energy. What do you see any opportunities there, given the big gains in a lot of those stocks, but earnings still kind of making a comeback here? Can investors still get into any of those? And do you still like Chevron? Because that's always been your favorite whenever I've had you on. And they're still paying that 5% dividend at Chevron.
Yes, I think there's still opportunities in energy, and yes, I still like Chevron. It's such a smaller slice of the broader market pie that I feel that most investors are underexposed to the area, and one could get a little fancy and take risks in terms of the E&Ps and the service players, but a company like Chevron is totally a much safer way to have energy sector exposure. I buy into all the conversation about carbon and environmental issues and all of that, but that's years in the future. We will be relying on these traditional energy companies for a long time, and these are very well-run companies. They have impressive returns on invested capital. They pay good, stable, juicy dividends, and obviously, just some small portion of the portfolio being in the space makes perfect sense from a diversification standpoint as well.
Yeah. Okay. So we do have reasons to be bullish, it sounds like, going through the rest of this year.
Oh, absolutely. Absolutely. Yeah. The outlook, look, earnings at the end of the day come from GDP growth, economic growth, and then margins. And margins were hit hard by the pandemic, and GDP growth was hit hard by the pandemic. And the outlook for economic growth for the U.S. economy is in the vicinity of how we used to see for emerging markets. So I'm reading estimates for Q2 that are in double digits for the U.S. economy. We have never seen those kind of estimates before.
Yeah.
The government is planning on, or at least talking about, more spending on infrastructure and other parts of the economy that should sustain the growth momentum beyond 2021 and 22, and all of that is positive for earnings. So there's a lot to be optimistic and favorable about the market as a whole.
Okay. Well, this sounds good. I probably will have you back on later on in the year so we can kind of see how it's all turning out. And hopefully it does have this bullish trajectory. It seems like it will. So this could be one of the record years, right?
Yes.
Yeah. Okay.
Yeah. I strongly feel that the revisions trend, the positive revisions trend, has not fully run its course. And as estimates for the economy ratchet up, we'll see earnings estimates follow that in the coming weeks and months.
Okay. So if you're interested in earnings season, be sure to check out Shiraz's earnings trends reports. They're on Zacks.com every week. You can check out what it looks like for earnings season on there. You can also look at just our earnings page. We have a whole tab which tells you everything that's going on during earnings season, including the big surprises. And you can also tune in to my earnings all-star videos. I'm going to be starting those up again when first quarter earnings season starts up about mid-April. So we'll be covering everything going on with earnings here at Zacks, and we'll be having more podcasts. So be sure to follow us or get the podcast somewhere. The Zacks Market Edge is on Apple Podcasts. It's also on Spotify. We're on Amazon Music now. I know not many are over there, but you can get us on Amazon Music. If you can't find us somewhere else, get us there. But let me recap the tickers again so that you know kind of what we talked about on this episode. So we did talk about some of the airlines. Southwest Airlines is LUV. United is UAL, Delta is DAL, Spirit, one of the domestic flyers, is SAVE, SAVE. Zoom Video is ZM, not the other one, ZM. Amazon, AMZN, of course, Target, TGT. We talked about Dick's briefly, Dick's Sporting Goods, DKS. Macy's is just M. Masaryk is the mall operator, MAC, and Chevron in energy, CVX. So be sure to subscribe again, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.